Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the crazy world of corporate finance without putting you to sleep. Well, maybe just a little bit, because today we are diving deep into Yum Brand's latest annual report. And let me tell you, there is a lot to unpack, especially concerning their financials and some rather creative accounting practices before we jump into the juicy details. If you appreciate getting straight insights from these dense corporate documents like this one, make sure you are subscribed and hit that notification bell. Also, we have a thriving Discord community focused on breaking down these filings. Link is in the description below, you do not want to miss out on it. Alright, so we are looking at Yum Brand's annual report for the year ending the 31st of December 2025. This is their big shake-up report, and they've got a lot going on from the get-go. They tell us that 97% of their restaurants are run by franchisees, which is key to their whole business model. They're not actually running the restaurants directly, it's all about the franchise agreements and fees. Let's look at the numbers for 2025. They have a massive 63,285 restaurants globally. That is a lot of burgers and tacos and fried chicken. The breakdown shows KFC is the biggest with over 33,000 locations. Taco Bell is doing its thing with over 9,000, and Pizza Hut is still a giant with nearly 20,000 locations. But then there is Habit Burger and Grill, a much smaller player with only 384 locations. Now, for the money part system, sales for all restaurants company owned and franchised reached a whopping $68.3 billion. That is a massive number. But remember, Yum only gets a slice of that through fees and royalties, not the full sale amount. Their GAAP operating profit for 2025 was $2.6 billion. That sounds good, but then they talk about special items. These are costs or gains that they don't think reflect their regular business operations for 2025. These special items added up to $122 million in expenses. They had charges for a Pizza Hut strategic review brand headquarters consolidation, and costs related to a German acquisition plus a Turkey termination. It's like they are constantly restructuring and spending money on it. When you take out those special items, their core operating profit comes in at $2.7 billion, a 7% increase from the year before. Net income was around $1.6 billion, and diluted earnings per share, or EPS, was $5.55. That is a 6% increase in EPS excluding those special items. Let's talk about the restaurants they actually own. Company restaurant profit was $461 million, but their company restaurant margin percentage dropped to 15.7% from 16.9% the year before. That means for every dollar of sales at their own stores, they made less profit than before. This is important because while they only own about 3% of the restaurants, it's still a key part of their business and shows a dip in efficiency. Side there. Looking at the overall system sales growth excluding currency changes, it was about 4%, which is decent, but Pizza Hut division actually saw a 3% drop in system sales and a 9% drop in core operating profit. That is a pretty significant decline, suggesting some tough times for Pizza Hut compared to the other brands. Franchise and property revenues did grow by 5%, driven by more locations and franchisees doing well. But again, Pizza Hut's franchise revenue dipped slightly too. For KFC, their company sales jumped 32%, which sounds amazing, but note a big chunk of that is from acquiring restaurants in the UK and Ireland. Not just organic growth, same-store sales though were up a solid 3%, which is good news globally for KFC. Taco Bell is a star player. Their company sales were up 11%, and same-store sales grew a strong 7%. They also acquired 128 restaurants in the Southeast US, which really boosted their own store numbers. That acquisition alone added $191 million in goodwill, which is basically the premium they paid over the fair value of the acquired assets. Pizza Hut's company sales look tiny at only $51 million. Which is because they've been actively selling off their company-owned stores. This is part of their strategy to become more asset-light, but it also means their own direct profit from those sales is shrinking the division as a whole store system. Sales drop and operating profit decline by 9%. It's clear Pizza Hut Teat is the laggard here. Habit Burger and Grill is still in the red with an operating loss of $13 million, but they are growing. Their company-owned stores dropped by 5%, but franchise stores grew by 24%, so they are shifting to a more franchise model there. The goodwill on their books has significantly increased to $969 million, a big jump from $736 million. The previous year, this is mainly due to those restaurant acquisitions, like the Taco Bell and KFC UK deals. This goodwill is essentially the premium they paid, and it suggests they are actively buying up franchisee locations to consolidate their brands. Total assets grew substantially, hitting over $8 billion. This is largely driven by that increased goodwill and intangible assets from the acquisitions. But here is a big red flag. Their long-term debt has also increased to nearly $12 billion. That is a lot of money borrowed. And while they say they are targeting a specific leverage ratio, it's always a concern when debt grows that much. Now, for some legal drama, the IRS is hitting Yum with a massive proposed adjustment of $2.1 billion plus penalties and interest related to some corporate reorganizations. Back in 2014, Yum is fighting this tooth and nail in tax court, saying they don't owe it. But if they lose, this could be a huge financial blow. They also have a regulatory issue in India involving a penalty of around $125 million related to old franchise agreements. Yum thinks the order is flawed and has a stay in place, but it is still a lingering legal risk. On the tax front, they currently have $115 million in unrecognized tax benefits, which are essentially tax positions they've taken that might be challenged by tax authorities. This adds another layer of uncertainty to their financial picture overall assessment. So what is the story here? Yum Brands is definitely growing, especially with acquisitions in KFC and Taco Bell they are pushing forward with their digital platforms and aiming for that asset-light model, but they are also carrying a lot of debt, dealing with significant legal and tax battles, and their Pizza Hut division is struggling. The big question is if these acquisitions and their digital push can truly overcome the headwinds from their debt and those massive tax liabilities. It is. It's a balancing act, and the market will be watching closely, especially if that IRS case goes against them. What do you think about Yum Brands' performance and their aggressive acquisition strategy? Let us know your thoughts in the comments below, and if you found this dive into their financials useful, please hit that like button and subscribe for more corporate deep dives. Remember, you can also join our Discord community for more real-time discussions and analysis. It's a great place to connect with fellow corporate decoding enthusiasts. Thanks for watching, and see you next time.